Hey everyone, welcome back to the channel. Today we're diving deep into one of the most misunderstood yet powerful strategies in retirement planning, the Backdoor Roth IRA. If you're a high earner who's been locked out of contributing to a Roth IRA because you make too much money, this video is for you. And if you've heard terms like backdoor Roth or pro-rata rule thrown around but never really understood what they meant, stick around because I'm breaking it all down. What exactly is a backdoor Roth IRA? Let's start with the basics. The backdoor Roth IRA sounds mysterious, so what is it? Simply put, it's a two-step process that allows high-income earners to get money into a Roth IRA, even when they're above the income limits for direct contributions. Here's how it works. Step 1. You contribute to a traditional IRA with after-tax dollars. This is called a non-deductible contribution. Step 2. You immediately convert that money to a Roth IRA. That's it. 2 steps. Now, the reason this works is because while the IRS has income limits on who can contribute directly to a Roth IRA, there are no income limits on Roth conversions. And that's the key difference. Congress intentionally designed it this way. This isn't a loophole. It's working exactly as intended. Who should actually use this strategy? Now, just because something exists doesn't mean everyone should do it. The backdoor Roth makes sense for specific types of people in specific situations. First, you're a great candidate if you're a high earner above the Roth IRA income limits. For 2026, if you're single and make over a certain threshold, or married filing jointly above another threshold, you can't contribute directly to a Roth. That's where the backdoor comes in. Second, this works best if you don't have large pre-existing balances in traditional IRAs, SEP IRAs, or simple IRAs. We'll talk about why in a minute, but trust me, this matters a lot. Third, you should have a long time horizon before retirement. The real power of a Roth isn't just the contribution, it's the decades of tax-free growth that follow. If you're planning to retire in 2 years, this probably isn't your best move. And finally, you're ideally already maxing out other retirement accounts like your 401k. The backdoor Roth should be layered on top of a solid foundation, not replacing it. When does it not make sense? When should you avoid this strategy? If you have significant pre-tax IRA balances already sitting around, the backdoor Roth can get messy and expensive due to something called the pro-rata rule. We'll dive into that shortly. If you need access to your money in the near term, a Roth IRA isn't ideal. Yes, you can withdraw your contributions anytime, but the goal here is long-term tax-free growth. If you need flexibility, a regular taxable brokerage account might serve you better. Also, if you expect to be in a much lower tax bracket in retirement, locking in today's tax rate by converting to a Roth might not be your smartest play. Sometimes keeping money pre-tax makes more sense. And finally, if you're already heavily weighted toward Roth accounts, adding more might reduce your tax diversification. Having a mix of pre-tax, Roth, and taxable accounts gives you the most flexibility in retirement. All right, let's get into the mechanics. When done cleanly, this process is surprisingly simple. Step 1. Open a traditional IRA and a Roth IRA if you don't already have them. You can open these at any major brokerage. Step 2. Make a non-deductible contribution to your traditional IRA. For 2026, that limit is around $7,500 depending on your age. The key word here is non-deductible. You're not taking a tax deduction, you're putting in after-tax money. Step 3. Convert that money from your traditional IRA to your Roth IRA. Many people do this immediately, sometimes the same day or within a few days. When executed properly, this conversion has little to no tax impact. Step 4. File IRS Form 8606 with your tax return. This form tracks your after-tax basis and prevents double taxation. This step is critical. Don't skip it. Keep the money in cash while it's briefly in the traditional IRA. Don't invest it yet. Why? because any growth that happens before conversion becomes taxable. Once it's in the Roth, then you invest it. From that point forward, all growth is tax-free. The pro-rata rule, the hidden trap. Here's where things can get tricky. The pro-rata rule is the number one reason backdoor Roths go sideways. Here's the concept. The IRS doesn't let you cherry-pick which dollars you're converting if you have other traditional IRA money sitting around. In their eyes, all your IRA balances get lumped together. Let's say you contribute $7,500 to a traditional IRA as part of your backdoor Roth strategy, but you also have $50,000 sitting in an old SEP IRA from a previous business. The IRS looks at your total IRA picture, $7,500 after tax, $50,000 pre-tax, for a total of $57,500. When you convert that $7,500, the IRS calculates what percentage of your total IRA balance is after tax. In this case, only about 13%. That means 87% of your conversion is taxable. So even though you just put in $7,500 of after-tax money, you'd owe taxes on about $6,500 of that conversion. Ouch. This is why account structure matters so much before you ever start a backdoor Roth. How to avoid the pro-rata problem. The good news? There are ways to clean this up. The most common solution is rolling your pre-tax IRA balances into an employer 401k. This assumes your plan allows roll-ins, but many do. By moving that money out of your IRA and into your 401k, you remove it from the pro-rata calculation. Problem solved. For self-employed individuals, a solo 401k works beautifully for this. You can roll existing IRA balances into it and clear the runway for clean backdoor Roth contributions going forward. Here's the key. You fix the pro-rata rule before you make the contribution, not during or after. Once the conversion happens, the IRS looks backward at your total IRA picture, so the planning has to happen up front. And this is why I always tell people, if backdoor Roths are part of your long-term strategy, avoid setting up SEP or simple IRAs in the first place. They complicate things. If you already have them, don't panic. You can fix it, but don't create the problem if you can avoid it. Can you contribute and convert on the same day? Yes. There's no waiting period required. Can you do this every year? Absolutely. As long as you're eligible to contribute to a traditional IRA and your financial situation supports it, you can repeat this annually. Does the step transaction doctrine apply? No. This is a common worry, but the IRS has allowed backdoor Roths for years. Congress has acknowledged them repeatedly. As long as you follow the process correctly, you're good. What about Form 8606? This is your paper trail. It tracks your after-tax basis and prevents double taxation. File it every year you make a non-deductible contribution or do a conversion. Tax software handles it easily, but make sure it's accurate. Common mistakes to avoid. Let me save you some headaches by pointing out the most common errors. First, forgetting to file Form 8606. Without it, the IRS has no record of your after-tax basis, and you could end up paying taxes twice on the same money. Second, ignoring existing IRA balances. Don't just focus on this year's contribution. Check for old SEP or simple IRAs you might have forgotten about. Third, investing too early. Keep the money in cash in the traditional IRA. Once it's converted to the Roth, then invest it. Fourth, assuming your tax software will auto-correct mistakes. Software is only as good as the data you give it. Double-check your inputs, especially around basis. And fifth, creating a SEP IRA without thinking about future backdoor Roth implications. If this strategy is part of your plan, choose your account types carefully from the start. And the bigger picture, why this matters. The backdoor Roth isn't just about getting money into a Roth account. It's about building tax diversification and long-term flexibility. Roth accounts have no required minimum distributions during your lifetime. they grow tax-free, and when you pass them to heirs, they inherit that tax-free status. But here's what matters most. Going into retirement with a balanced mix of account types gives you control. You can manage your tax bracket, minimize Medicare surcharges, and adapt to whatever the tax code looks like decades from now. The Backdoor Roth is just one tool in that toolkit. Use it intentionally, structure it properly, and it becomes incredibly powerful. If you're a high-income earner looking to maximize your retirement savings, the Backdoor Roth deserves serious consideration. But don't do it blindly. Understand your account structure, plan for the pro-rata rule, and file your paperwork correctly. Done right, this strategy can add tens or even hundreds of thousands of dollars in tax-free growth over your lifetime. If you found this helpful, drop a like and subscribe for more content like this. And if you have questions, leave them in the comments. I read every single one. Thanks for watching, and I'll see you in the next video.